Welcome to the Thomson Reuters Idea of the Week and Alpha Now. I'm John Cozy. You probably know all about those sell in May articles, but few commentators look beyond the general market. Well, we did and found some S&P 500 sectors that actually made money in the seasonally weak May through October period. Let's see what happened to $1 million invested in a few sectors. The world's changed a lot since the start of the 21st century, with the dot-com bubble bursting and the S&P 500 high in March of 2000. The average annual loss for the market in May through October for the last 12 years was about 2%, turning that $1 million into only $690,000. We backtested the 10 economic sectors shown on this StarMine page to see how each one performed year by year using QA Studio. Let's start with the ones that fared the worst. The telecom services sector is our third worst May through October performer, dominated by AT&T and Verizon. Money invested here turned into a 43% loss. The second worst sector was consumer discretionary, with names like Amazon, McDonald's, and Disney. You can see those 7 red bars showing years when the sector lost money in the seasonal period, shrinking $1 million to $570,000. And the worst sector to own lately from May through October is information technology. $1 million would have lost 50%, even though the green bars in the chart show that half the years showed positive results, with sector names like Apple, IBM, and Google since 2004. So 2 of the more aggressive sectors showed the weakest returns. Now, let's see who made money from May through October. Our third best sector to own was utilities, returning about 9%, which includes the larger names Southern Company and Exelon Corp. Results would have been better if it weren't for big down periods in 2002 and 2008. Healthcare is our second best performing sector. For all the recent challenges with managed care, Obamacare, and Medicare, it's turned out to be a decent place to hide. But this time of the year, boring was good for names like Johnson & Johnson, Pfizer, and United Health. And the top chart's net asset value shows a 27% total return. And speaking of boring, the sector that performed better than any other from May through October? Consumer staples. Those soap, food, and toothpaste companies didn't go up a lot, but they sure didn't go down a lot. Factor in reinvested dividends, and its 28% holding period return edged out number 2 healthcare by a nose for top honors. Names like Procter & Gamble, Coca-Cola, and Kraft Foods beat all the sexier sectors in the S&P 500. Stocks that usually get no respect would have made Rodney Dangerfield proud. So if you're investing over the seasonally weak May through October period in this century, remember that the sports phrase, "the best offense is a good defense," has certainly worked when it comes to sector picking in the S&P 500. For the Thomson Reuters Idea of the Week and Alpha Now, I'm John Cozy.